So you are all welcome to this efficiency course. I'm saying that this course is necessary for your research. I am teaching it in the context of as if you're about to write a research. Normally, I would teach it as a model, as a module where you answer exam questions and things like that. But this time, I'm being a bit more practical related to thesis, a research, a journal publication that you would have probably even done. So I want you to please pay attention and, of course, also ask any question that you can ask. So what is efficiency? We'll be talking about that very soon, but why efficiency? Now, the word efficiency sometimes is interchangeably used with performance. So if you see me use efficiency a lot, I'm also talking about performance. So please note that. You see me use efficiency, I'm talking about performance. If you see me perform, but they are very different. Performance is more encapsulating. It captures so many other things. We would also be distinguishing between efficiency and productivity. But for now, keep this in your mind and note it down. Efficiency is performance at a time. Productivity is performance over time. Efficiency is performance at a time. Productivity is over time. So productivity looks at different times. Efficiency looks at one time period. So it doesn't really distinguish between times. It can look at just one time period like 2009 alone. Or it can look at multiple times, but will consider all of them as one time. So you can look at all observations from 2000 to 2010, and yet it will consider everybody as one time period. It ignores time. That is efficiency. Why do we look at efficiency of firms? Well, it allows us to select best practice firms. The best practice firms are those firms that are efficiently performing than the others. Efficiency analysis helps to identify areas of improvement. So if you're able to do efficiency analysis, you are able to identify where the firm can improve to become better. When you do efficiency analysis of, say, the banking industry, you are helping the government to make banking policies. You can even do efficiency analysis of countries, and you will know whether or not to cut budgets. It will help in the monetary policies and the fiscal policies. Efficiency analysis is good for the firm because management are able to be competitive. For example, through efficiency analysis, management of a particular bank will be able to know that, wow, it looks like EcoBank is doing better than us. So we need to be competitive. And then the efficiency analysis will help them to know what they can do to be competitive. Sometimes you do efficiency analysis and you realize that some of the firms are too large. In that context, there's something we shall learn here is called returns to scale. The returns to scale analysis we shall do for this course will help you to know that some firms are too large and some firms are too small. Now, if some firms are too large and other firms are too small, what it means is that it could lead to something we call mergers and acquisition. What is that? What is mergers and acquisition? Well, mergers and acquisition is that if you are too small, then you can merge with another firm that is too large so that you can support each other. That's mergers and acquisition. Efficiency analysis helps in benchmarking. Benchmarking here means that you are able to identify those that are doing well, and they will serve as role models for those that are not doing well. And of course, through efficiency analysis, you can do PhD, masters, and several other things. Because through the analysis, you're able to identify gaps that have to be done, or gaps that have to be filled. And then you are able to now handle those gaps. Efficiency analysis is very important for managers, for regulators, and for the government. In fact, it's also very, very important for researchers to be able to know areas to dig more into. For example, if you're a researcher, you can make a policy to the government to orientate their actions towards a particular section of the economy. For example, you might detect that the foreign firms, even though there are plenty, foreign firms are coming into the industry so much, it doesn't mean that they are helping. They are not generating technological spillovers. There is no spillover activities coming from the foreign firms. And so you can then decide to put restriction on entry of foreign banks, because after all, they are worrying the domestic banks. Efficiency analysis will help you to detect all of this. Now, before you do efficiency analysis for any thesis research, there are steps to undertake. The first is to identify which industry or firms you want to deal with. And these firms should be homogeneous. We call them DMUs. What are DMUs? Based on your readings, you can tell me what are DMUs?
So they are decision-making units.
Good. Decision-making units. So these are not necessarily companies. Because when you go to the university and then you are looking at the department, the university department, you realize that you don't need to call the department companies. So these are called decision-making units. Now, decision-making units are those firms that are using similar inputs to produce similar output. So they have to be similar. That is the homogeneity assumption. Select homogeneous firms. Homogeneous here means that they are similar. They are similar. If they are not similar, you can't combine them. Because you cannot combine secondary schools and universities and say because they are all schools, you are trying to assess their performance. Wrong. Because secondary schools teachers, they don't publish articles. But university professors publish articles. So if you do that, you are mixing apples with oranges. So the first thing in efficiency analysis is, first of all, you must have multiple firms. You can't just go and take one particular firm or just 2 or 3 firms and say you want to do efficiency analysis. That's wrong. That's wrong. You got to have multiple firms because it's going to be a benchmark analysis. You are going to compare firms against firms. So if you have just a few firms, the comparison will not be effective. So these are some of the homogeneous DMUs you can have. Can somebody mention any homogeneous DMU that is not on this list? Can somebody mention anything that could be a DMU but not on this list? Who is bold? Can somebody mention anything that is not on this list? The problem is that if it's on the list, then you're in trouble. Then you don't even think. Dentistry.
Say shipping firms.
Shipping firms. Schools. So schools, you can do 3 different groups. You can only look at secondary schools and then primary schools. And even the tertiary schools, you have to split them. You cannot compare universities with polytechnics. Neither can you compare polytechnics with teacher trainings. They have to be homogeneous. You can assess the efficiency of libraries, police, internal revenue services, farms, courts, air force. You can compare. In fact, there are so many professors who are looking at the efficiency of athletes, footballers, soccer, university department, countries. You can assess the efficiency of countries. In one of the papers you will learn about FAIR et al. 1994, we developed a productivity index to assess the efficiency of countries. Electricity distribution districts, EDDS. I had one master student do that, electricity distribution districts. Cities. Okay. Some have looked at the efficiency of cities like Manchester, London, Liverpool, Milton Keynes, Coventry. They've looked at the efficiency of cities. Of course, you struggle to try and do the efficiency of cities in Ghana because the cities don't have any data on them. You can assess the efficiency and the productivity dynamics of oil firms, banks. And I think many of you are doing banks, but I don't think anybody is doing bank branches. Fishing, sometimes we call them fisheries. Hotels. There's hotels here. You have restaurants, supermarkets, insurance firms or insurers, airlines, airports, prisons. Can you think of something else that's not here? Because your ability.
Transport. We have STC, VIP, we have OA, and a whole lot.
You said VIP?
I said we have in the transport sector, we have VIP, STC, we have OA, and other private transport companies. So we can measure the dynamic efficiency of all these people.
Private transport company, I think I love that one. That is not bad. We are thinking beyond the human imaginative systems. So that's good. What else?
Say telecommunications firms.
Telecoms, very good. Powerful. What else? What else? Anytime you think about it, what it means is that you should consider it as multiples of that. So there must be multiples of such companies. And you are right in this context. Any other, you've got to be able to think about one or two more. Which will follow?
Gaming companies.
Gaming companies, very good. You've been playing games a lot, eh?
Yes, sir.
What else?
So how about consultancy firms?
Yes, consulting firms. That's very good. Like PricewaterhouseCoopers, Ernst & Young, Deloitte and Touch, things like that. Yeah. It's fine. In one of my assignments, if you were doing the MPhil, in one of my assignments, I will let you list 20 firms that are homogeneous firms like that. So you got to go think about these ones because this is critical. It's very important. If you can do that, you can do a lot. And many people sometimes forget that they can do this. Just a second. So these are the companies you should look at. Now let's look at step 2. So you've gotten your firms. I think all of you now have your DMUs. Is that correct? All of you on this course have selected your DMUs. Is that correct?
Yes, sir.
Okay. The next thing after selecting your firms is to ensure what I'm about to tell you, which actually implicitly assumes that it's already done. It's already done when you were selecting the firm. Because the DMUs should use similar inputs to produce similar outputs. That has to be ensured. That the DMUs should use similar inputs to produce similar outputs. And therefore, you have to make sure that there are inputs to identify and there are outputs to identify. If there are no inputs to identify and there are no outputs to identify, then you don't have DMUs. So you've got to ensure that there are inputs and outputs to identify. You've got to make that clear. You have to. Inputs. And it is one challenge. It's not going to happen immediately. It's one particular challenge you're going to face. As far as inputs and outputs are concerned, it's taking some people a whole new thing to write about. Writing about the inputs and outputs to identify. It's not simple. It can take you a whole long time. And you got to think. This is where you got to think. This is where you have to think. Dinah has been thinking a lot about how to identify unique inputs, outputs, and even prices of the inputs and outputs. It's a whole new exercise. The good thing is that some people would have already done it in the literature. And so sometimes you will have a kind of a pattern from which you can select and also do your own. In the inputs and outputs, the inputs and the outputs should be non-negative. What does that mean? What does it mean that the inputs and outputs should be non-negative? Yes, who can help? What does that mean? He's talking. The input and the output should be non-negative means that you should have purely positive input and output. The assumption of non-negativity is important. However, there have been models that have now been developed to deal with non-negative data, because you can have profits, which is a loss. Through no fault of the company can make losses. So in this context, you got to get models, specialized models that handle such situations. And it is very important to recognize this, special models. But the key point is that the input must be, so if you identify an input like deposit for this bank, every other bank must also have deposits. If you identify an input like claims for this insurance, every other firm or insurance firm must have that claims. If you identify any input, it must be meaningful. It must be comprehensive. It's got to be operational. It has to be something that is used. It's got to be meaningful. One manager should not say, oh, I don't think this one will be considered as an input. It must be generally acceptable, comprehensive enough. And to do this, you got to search the entire literature. And this is where the taxonomy papers become useful. So that's why I initially told you to gather a taxonomy. Because based on the taxonomical studies, survey papers, they would have clearly helped you to know the various inputs and outputs that have been used. And this will really, really help. So there is a whole video by one professor on YouTube that details out all that have to be done as far as input and output is concerned in efficiency and productivity analysis. And I will urge you to go watch the entire video. It's a very powerful video when you are selecting the inputs and outputs. Now, let's look at a typical example of bank input and output. This is a typical example. Depending on the work you might be doing, you remove some and you will add some. So When you are dealing with the inputs of banks, you are talking about the deposit. And this deposit, you got to be very clear about which deposit we're talking about. Because in the annual reports of the banks, you will see call deposits, time deposits, and several other different kinds of deposits. Okay. Sometimes the bank will get another bank depositing into it. Those are not the deposits we are talking about. Okay. We are talking about a real customer deposits. And so you got to be noticing that. This is usually in the annual report. Then salaries. Now, if most of the time, if you can get it, you would rather go for the labor. Labor here, you will use the number of workers. But it was identified that, especially in our kind of data, it's difficult to get the number of workers, the employees. It's difficult. And so in the literature, majority of people who can not get that will use salaries. They will use salaries. But if you can get the labor, you will then use labor. However, some even argue that the labor doesn't reflect real value. Because if you have a cleaner and then you have a CEO, you will count them as two. But the value attached to each one of them is different. The CEO will have a higher value attached to it than the cleaner. But when you take labor, it doesn't capture the entire value. Now, when you take salary, you see that maybe one is getting $500 and the other is getting $10,000. So that value captures the labor. Does it make sense?
Yes, please.
Yeah. Yes, Doc.
So you got to really think through when you are selecting input and output, think it through with your colleagues and with your supervisor to guide you, to help you, to know the first move that you make. Then you have another.
Hello, Doc.
Yes.
Hello, Doc. What about if you take the labor and you assign levels?
Increase your voice.
What I'm saying is that with respect to the CEO and the cleaner, for instance, what about if you do not want to go with the salary and you assign numbers based on their ranks? Maybe CEO, you attach a higher.
Everything you do with terms of rankings and all of those, it is seen as subjective. What number are you going to assign to CEO?
You have to from 5, 1, 3. Then you find in that case, you can use the figure.
That is subjective.
Based on the ranking. Okay.
Is that not subjective?
Okay.
It's subjective. It has to be an objective thing.
Okay.
Because if you assign 12 to CEO, but then another company will assign 13 to CEO, then it means that we have different kind of values. So that can be debated, and we don't want a situation. But the salary, that one, it is in the book. You just pick it. So nobody can come and then disturb it. 1 second. So, do you get the answer to your question? We don't need subjectivity. We need objectivity. Okay? The next thing is fixed assets. Fixed asset has to do with property, plant, and equipment. In some of the annual reports, they will write fixed assets. Some will not write fixed asset. They write property, plant, and equipment. Once you know that this is it, they will reflect that. Then we have financial assets or equity. Sometimes they call it shareholders' funds. Another input. This input is used to address technical efficiency. Technical efficiency. But we have another one dealing with cost efficiency. When you are dealing with cost efficiency, then you got to look at the input prices, which is in the third column. So in the third column here, you'll be dealing with input prices. So for example, the price of deposit is going to be interest expense divided by total deposit. So the price on deposit, it should be a ratio. It should be the interest you are incurring on the deposit divided by the deposit itself. The same way the price of labor is usually the interest. Okay, so if you had used, and this is very important, if you had used number of workers for the labor, then the price of labor will be number of workers divided by, it will be salaries divided by number of workers. That's how it would have been. But because in this context, you didn't use number of workers because the number of employees are difficult to find for all banks. So you use salaries. Then the price of labor is going to be the salaries divided by total assets. The salaries divided by total assets. Are you guys with me?
Yes, Doc.
It's very important you are following and getting this.
Yes, Doc.
Now, the next thing is the price of capital. I told you earlier that capital is a fixed asset. So the price of capital will be the expenses you make on fixed asset. So if you are using a certain fixed asset, okay, you use something in the annual report to known as other operating income. Other operating expenses. Because the normal operating expenses is expenses on labor. But the other ones is considered to be that of for capital. And so that is where you normally have depreciation, amortization. All of that include the other operating expenses. When you divide that by the fixed asset, that gives you the price of capital. So in short, you can have the price of every input. I did not do that of shareholder here. But you should understand that every input must have its price. The same way you need output, loans and advances is one of the main output because a bank engages in using the customer deposits to generate loans. So they will collect you and I, our deposit, and they will give you and I, our deposit to you and I as our loans. And that becomes an output from the bank. Of course, you can have an output that is not necessarily being generated through a particular thing. For example, if you look at this total investment could be the deposits, and some of the deposits are being used to generate investment. The same deposits are being given as loans and advances. The same deposit are being given as total investment. So it doesn't mean that the way the information has been written doesn't mean that salaries would lead to investment. And then you have other earning assets. Other earning assets include other investments apart from the normal investment, like government bonds, treasury bill bonds, and so many other eligible bills, and so many other things. And then for those of you who are doing corporate social responsibility, you have another output that comes as CSR. And CSR, if it is considered as an output, then it has to be included as an output. Some have suggested that CSR should be considered as an input. Some have suggested that CSR should be considered as an undesirable output. Those of you working on CSR should think and expand your understanding on this CSR because it's a very powerful topical area. Then you can have the prices of the output as well. So once you have the output prices, then you are now in the world of profit efficiency. Any questions so far on what we've discussed about these inputs? These are powerful, important points you're learning. Now, how many inputs should you use? And how many outputs should you use? There is no hard and fast rules If we are to represent the input by M, output S, and then the number of firms, to be honest, there was a type.
Hello, Doc.
Yes.
So please, if we are looking at efficiency, meaning we are going to look at technical efficiency, cost efficiency, or profit efficiency in
Yes,
one,
one
or
of
we are
them.
going to take one of them and okay.
There's one of them. When we get to selection of the efficiency, you will select which one. And of course, I'll guide you in selecting which one is best for you.
Okay, Doc.
Good. That means that you're following. So the information you have here shouldn't have been the number of outputs.
Yes, Doc.
All right.
Yes.
So you can see that it's supposed to be the number of firms. So the rule that has been given by several authors, Golanin and Roll in 1989, and Tyson in 2000. So the rule is that for so many different rules, okay, the number of firms should be greater or equal to the 2 times the input plus the output. So let's say the inputs are 3, the outputs are 4. So you have 3 plus 4. 3 plus 4, that is 7. 2 times 7, that's 14. So it means that we want the sample size should be more than 14. In fact, in many cases, the last one will tell you that the sample size should be bigger than 2 times the input times the output, according to Dyson. Okay. So these are some of the rules. Trust me, many a times, all of your data you have will be more. Many a times, the sample size you have, which is the N, will always be more than the variables by any particular standardization. So that is one thing that you should note, that the number of inputs should be smaller. In short, what it simply means is that the sample size should be more. One of you just asked what type of efficiency. Do you remember? And I said, you choose one. So, what type of efficiency are you going to look at? So the next step in efficiency analysis is selecting which type of efficiency to deal with. Please note that even though you're going to select this yourself, you also want it to be a bit unique, special. So if you are selecting something that everybody has been doing, it's not that interesting. So you want to select something that, yeah, people have been doing, but also something that not everybody is doing. That is the whole point. That is the whole point. So the first efficiency you'll be dealing with is technical efficiency. We'll come to a point where we'll fully explain it. But for now, put it in your mind that technical efficiency has to do with managerial performance. It is efficiency attributable to management effort. Technical efficiency is that kind of efficiency where the firm is able to maintain the input whilst increasing the output, or maintaining the output whilst reducing the input. Does it make sense? Maintaining the input whilst increasing the output, or maintaining the output whilst increasing the input. Both of them means that you are dealing with technical efficiency. And that can be done only if you are a manager. If you're a manager, then you can do this kind of efficiency. The next kind of efficiency is mixed inefficiency or mixed efficiency. That one incorporates slacks. We'll talk about slacks in due time. Then you have pure technical efficiency. Now, pure technical efficiency is when you believe that the technology is under VRS, variable returns to scale. I'll come back to talk to you more about technology. You have the scale efficiency, the scope efficiency, the allocative efficiency, the cost efficiency. Okay, so all of these. Then you have the revenue efficiency, the revenue efficiency. And then you finally have the profit efficiency. Now you can do all of these things in the world of productivity as well. That's it. These are the three types of efficiency that has to be done. Now, any questions so far? Any questions so far? These are the types of efficiency that you got to know. Of course, what we will do next time is to dig into the various types of efficiency. That's what we're going to look at.